Hi, this is Howard Huang with the St. Paul Group. Thanks for joining us today. When my partner and I speak with real estate investors, especially newer investors, the most common sets of questions we receive are there's so many different types of real estate investments. What made you pick mobile home parks? And geez, that sounds interesting. Can we do it? So that got us thinking. The topic of today's video, we call it What Color is Your Real Estate Parachute? Also known as Why Do We Invest in Mobile Home Parks? So I think you'll agree that there are so many different ways to make money in real estate investment these days. Whether your focus is residential, commercial, land development, and whether your strategy is lease options, foreclosures, short sales, fix and flips, buy and hold, or even private lending, there's so many different ways to make money. In fact, there's so many different ways that it can get very daunting for the new investor trying to focus on their specialty. So what we're going to do in today's video is a little bit different. We're going to share with you the exercises and the thought processes that we did when we first started investing. What you're going to see is that these were very simple exercises, but by doing so, my partner and I were able to figure out that based on our skill sets and our goals, mobile home parks were the best fit niche for us. We didn't happen upon it by accident. So if you can sit back, grab a pen and paper, and do some of the exercises, I think you'll find this worthwhile, especially if you've been trying to get some focus in terms of your real estate career. In today's video, we're going to talk about your strengths and weaknesses, your investment profile, why mobile home parks fit for us, and also whether you are an active or passive investor. SWOT analysis. This was the first exercise that we did. SWOT stands for strengths, weaknesses, opportunities, threats. A SWOT analysis is a fairly common exercise that's done by businesses when they're doing some forward planning. For our exercise today, just focus on strengths and weaknesses. For strengths, think about your skill sets that you have. Think about your resources and also any particular passions and things that you like that you know you'll do well. For your weaknesses, think about skills that you don't quite have a great handle on. Think about your constraints and think about just things that you just really don't like that you'll know you'll not do very well if you had to. So when my partner and I did this exercise, this is what we found. Our strengths. We're both very analytical, so number crunching was something that we're both very comfortable in. Between us, we had over 20 years of people and business management skills. Both of us had a passion for making our business processes extremely efficient and automating them. We had a very good comfort level with delegating responsibilities to other people, so we didn't really need to do everything ourselves. We were both problem solvers by nature, and being in startups, we both had a very entrepreneurial mindset. So what were our weaknesses? Well, at the time we did this exercise, we both had full-time jobs. We worked usually over 60 hours a week, so we had very limited time. Neither one of us are extreme extroverts, and we didn't really enjoy dealing with people, so the thought of tenants and toilets did not thrill us. Also, neither one of us were really hands-on people, so doing things such as rehabs didn't really fit into our model. And also, neither one of us really liked the idea of dealing with emotional transactions, and you'll see how that fits in the next slide. So sit down, think about your strengths and weaknesses, and most importantly, write it down. And in this next slide, you'll see how we evaluated this first exercise and what we found. So we mentioned that we had no time. We also didn't have very good skills with hands-on labor. So the idea of doing residential fix and flips or rehabs really didn't fit well for us. We knew a lot of people who made excellent money doing this, but that really wasn't the right niche for us, especially when we were trying to do this part-time with our full-time jobs at the same time. We didn't like emotional transactions. and we're both very analytical in nature. So what does this mean? Well, we really decided that commercial was a better fit for us. Commercial from the perspective that with our analytical backgrounds, we were more focused on the business aspect, the numbers of commercial. Residential has an emotional aspect to it. So the notion of doing, let's say, foreclosures and dealing with homeowners has an emotional aspect that neither my partner and I really wanted to get into. For some people, they are fantastic at this. For us, we really preferred the concept of commercial businesses where the business and the numbers, the NOI was the important factor. People skills, business skills, process improvement, delegation. These were our skill sets. What it really meant is that we were again focused on the concept of a business versus real estate, as in the building itself or the structure. We like the idea of getting into real estate before the perspective of having real estate be a business, and that really was our core strength. And I think from this you'll see that we had an angle that we were already heading towards. So after we did our SWOT analysis, we went through some next exercises, which is just going through our profiles and our goals. So here's a sample of an investor profile. These were just questions and aspects of investment goals from our perspective. By no means is this exhaustive. You could put your own in there, but these were the things that we considered as we were thinking about our investment goals. Time frame. Were we looking at short-term or long-term investments? What were our financial goals? Were we looking for capital gains, meaning quick cash, or long-term passive income? Our portfolio goals. Did we prefer having the idea of many smaller assets, let's say 50 small homes that we rented out, or a fewer larger assets? Performance consistency. Now, were we the type that really liked riding the emerging market cycle, or were we the ones that just liked slow, steady performance? Operations and management. We talked about the business aspect of having a real estate investment company. Did we prefer simple operations or more complex, elaborate operations? Also, along the notion of operations and management, were we tied to only investing in our backyards, which is Northern California, or were we comfortable with the idea of investing out of state and having to do remote management? Next, we're going to look at the niche in terms of the competition and liquidity. So for competition, were we focused on a niche that had lower competition or higher competition? So if everyone's doing it, do we want to go into that same niche, or do we want to go somewhere else where other people are not? And this has both pros and cons. Liquidity. So did we want to go into a niche that had low liquidity or high liquidity? Now this works inversely with the competition above. Usually niches that have high liquidity, let's say single family homes, also have higher competition, which makes sense. So you'll see that mobile home parks have a very low competition and also a very low liquidity in the next slides. And then also our personal commitment. We had to evaluate whether we really wanted to be passive investors or active investors. Okay, so think about these. Feel free to look at some of the other goals that are appropriate for you. Let's take a look at how we answered these. Okay, you probably figured it out. We were long-term investors looking for passive income. Our preference is fewer larger assets. For us, the ability to scale and to manage is much easier this way. From a performance standpoint, we really don't like the idea of having to time the market or the cycle or the location. Now, while demographics are extremely important, we prefer a more consistent, stable niche. In terms of operations and management, while we're very comfortable dealing with complex operations, to us, the simpler it is, the better it is. Because the less moving parts, the less chances of items breaking down within your operations. Also, with our skill sets in technology and delegation, we had no problems with the out-of-state investments and remote management. Competition. We prefer low competition. Usually, our mentality is if everyone is doing X, we prefer going to Y. Um, Next one is very interesting. You'll see we prefer high liquidity. Obviously, that helps out, especially when you're trying to buy and sell, especially on the sell side during exit strategies. But you'll see that what we ended up picking didn't fit in. So this one wasn't directly in line with our niche, but what we'll see with when we decided to pick mobile home parks is that with our other goals of long-term passive income and having very stable investments, that this particular um, goal was outweighed by the others. And lastly, from our perspective, we're both entrepreneurs, so we definitely knew we were going to be active investors. But let's take a look at the results. Long term. So buy and hold properties. We knew that. Passive income. We had to look for the niches that were high flowing, high cash flow investments. Fewer larger investments. So we had honed it down to commercial, multifamily. Non-cyclical. We really wanted recession resistant assets. Management, we talked about it. Simple, easier to manage, especially when we're going to combine that with remote management out of state. Lower competition. Well, we knew that lower competition usually meant that we weren't going to be investing in the bright, shiny new object or the sexy investment that everyone else runs towards. So no condos on Miami Beach. Higher liquidity. Well, higher liquidity would be great because you have more buyers if you ever decide to exit of a deal, but can't have everything. An active investor, well, that's simple. That's why St. Paul Group is born, and that is us.